Welcome back. Well, let's focus on our special offering value add today in this segment. Mangalam is here to tell us what is ailing D-Mart. Mangalam, it is the numbers?
It is the numbers, and it's weakness in the numbers over the last few quarters itself. If you just take a look at it, the stock was a D-Street darling. From its IPO price of $299 to its all-time high, it had actually rallied about 18 times up until October 2021. And even if you bought it at the listing, you would have been sitting on a 9 times gain as of October 2021. But from then to now, we've seen the stock price correct about 31%. This at a time when the mid-cap index was higher by 7% and the Nifty itself was up 5%. What is it that has happened? One, macro reasons. The first one, of course, was COVID-related disruptions. Remember, Mumbai had some of the strictest lockdowns, as did Maharashtra, and a large part of their stores are in this area itself. Secondly, high inflation, weak consumer sentiment has impacted their product mix, as a result of which their gross margins continued to compress. And then you had competition coming in from the likes of Reliance, the value offering from Tata Group, Trent, Zudio and Max as well. These are the macro factors, but D-Mart's own numbers itself, you just take a look at, this pace at which they are adding stores, that has been lower. That's point number one. Total stores of D-Mart have been, 324. If you just take a look at the store added over the last few years, in FY23 they added 40 stores as against 50 stores that they added in FY22. And Reliance itself has added 966 stores in one quarter. And in just the last 1 year, they've added 3,300 stores. So pace of store expansion is something that the street believes that the company can go ahead and increase. As of now, they have 13.4 million square feet in terms of retail space. Reliance Retail, in comparison, has 66 million square feet in retail space. The company's sales per square feet actually have still not gone back to pre-COVID levels. Pre-COVID, this number was close to 32,000, and now it is 31,000. In fact, pre-COVID, FY19, it was close to 35,650 itself. And the biggest reason for that is the contribution from general merchandise and apparel, which is a more discretionary part of the portfolio, has come down from 28% pre-COVID all the way down to 23% and is still not increased to that. As a result of which, the second big reason is the return ratio. ROCE is still pre-COVID levels. It has increased over the last couple of years, but remember, last couple of years were a favorable base as well. At 20%, it's below pre-COVID levels of 25.9%. The one thing that's working for the company is the steady growth in the rate of D-Mart Ready, which is their e-commerce business. Quarterly, now they've moved to around 230 crores, 250 crores in terms of quarterly revenue. This number was between 150 to 180 crores the same time last year, and operational metrics have improved out there as well. But here too, the street would like faster growth rate. And finally, D-Mart has never been cheap, and even after a 30% correction, it's trading at 74 times 1 year forward earnings and 59 times 2 year forward earnings multiple. So what are the things we need to watch out for going forward? Any improvement in revenue and product mix. Secondly, uptick in sales per square feet, which will of course be led by improvement in product mix, faster store additions, faster ramp up of D-Mart Ready. And you've been talking about the pharmaceutical pack, Ekta. They've also started an in-store pharmaceutical division. So any sort of ramp up out there is something that we'll be watching out for. If the company does that, then maybe it goes back to its glory days.
Okay, well, let's see. Avenue Supermarts, that stock down around 3.69% at this point in time. Time for a short break. But on the other side, Manisha Gupta will be with us. She has with her Kunal Shah, who's the head of commodities and currency research at Nirmal Bang. Stay tuned.